Hi everyone, welcome back. Hope you all enjoyed your lunch. If we could get everyone to please take a seat. We start with our next scheduled session, which is venture capital investing in India. So we have two guest speakers who are joining Vijay on stage, and I'll invite him to give a quick introduction of Suresh Shanmugam and Karan Pava.
My phone. Thank you. You can switch it on, please. Thanks. Can everybody hear me? Okay. So, I just tweeted a short while ago expressing my fears about addressing this audience at the graveyard shift right after lunch. And I was just also discussing with our speakers here, and we were placing bets on how many of you are going to stay awake through the talk, and we were strategizing how to keep you awake. One of the strategies that we discussed was that we would, just like Richard did in the morning, encourage you to ask questions as and when you feel like, rather than wait for the end of the talk. Let's make it more interactive, let's make it more engaging. With that, I'll go on to introducing the speakers. So we have Suresh Shanmugam, who is the co-founder and managing partner of Sama Capital. Now, Sama Capital is a Silicon Valley-based fund that is focused on investing in India. They have made some excellent investments and exits, and are a fairly well-known name in India, so they need no introduction here. We also have Karan Pahwa, who is the in-house lawyer, in-house counsel of Bessemer Venture Partners. Those of you from the US need no introduction to Bessemer. Bessemer is one of the oldest VC firms in the world. And Karan has been with the BVP team since 2011. And with that, I will invite both of them to take the stage here with me, and we will have, hopefully, a very interesting and engaging talk. Can you all see the slides? Are we blocking it? Okay. Okay, so I'll start by giving a quick introduction to the whole VC scenario in India, right? How relevant is venture capital? Venture capital is important indeed, but they are certainly, the levels of relevance vary from market to market. In a market like India, it's an extremely relevant and important player in the ecosystem, venture capital. And the first wave of VC investing in India really started in the late 90s. I don't think people in India had even heard of the word venture capital till the late 90s. And even when some early deals were happening, it was not really something that was popular amongst the general public. People had heard of investment bankers, people have heard of lawyers, people hadn't heard of venture capital funds. I think the big moment in the mid to late 90s, which changed that and made everybody suddenly very aware of venture capital, was one deal. It was the sale of Hotmail to Microsoft. And why did this deal matter so much in India? Because the founder of, one of the co-founders of Hotmail was Sabir Bhatia, Indian guy, and he shot to fame instantly because if I remember the numbers right, it was like a $300 or $350 million deal, which was mind-boggling for those days. And people couldn't understand, and Hotmail was hugely popular in India at that time, and people couldn't understand how a company that was offering them free email could have any value at all, let alone be valued at $300, $350 million bucks. And that's when stories started getting written about who Hotmail was and how they became big, and people started learning about how they raised funding from Draper Fisher, which is one of the oldest and better known VC firms in the Valley. And so then after that, there had been more focus on what VC firms had been doing in India, and there was regular reportage in the press. And VC activity started picking up. It soon got into a frenzy because of the internet bubble. And it all ended very abruptly in 2001 because most of the companies that were getting funded were literally, kids straight out of college with a spreadsheet saying, I've got an idea. And it was a little bit of a wave. It didn't last very long in India. And when the dot-com crash happened, everything came crashing down, and there were no more stories of VC money going into startups. Private equity investing, late-stage investing continued happening in the more mature businesses. And it is only in the second half of the previous decade that VCs made a comeback in India. Though funds like Bessemer and Sama have been around for almost a decade, or a little more than a decade, it is in the last decade that they have been really active. And that is also because there's been a surge in the quality of startups that has, what I call the second wave of Indian tech startups really started in the past decade. So this is some infographics to show you how the deal activity has been. As you can see, it has been a fairly active, space. There has been a lot more venture capital activity in recent times, and especially, I think, in the 2015 to 2018 phase, there's been a lot of activity after the revival from the recessionary times. Okay. Brief history in terms of regulation. It started in 1996 when the SEBI, which is the capital markets regulator in India, issued regulations to regulate venture capital industry. Not many domestic venture capital funds were formed, but a few were formed by leading institutions like ICICI and so on. And in 2000, SEBI, announced another set of regulations governing foreign venture capital investors. They did not make it mandatory for foreign venture capital funds to register in India, but they gave certain benefits to those who did so. And that suddenly saw, along with the fact that there were a lot of Indian companies then getting interest, over the next 5 to 6 years, more and more VCs actually started investing in the Indian market. Some of the key milestones I've set out in the right side column. The first unicorn in India attained the unicorn status in 2011. That was InMobi. It's not Flipkart, even though Flipkart is the most well-known Indian company. It was not the first unicorn, it was InMobi. In 2015, the number of Indian unicorns had gone up to 8. And in 2016, Sequoia closed a big fund, which is pretty big, by probably the biggest fund, I don't know, dedicated to India by any mainstream VC. And how has the whole thing played out? They have made some successful exits as well. For example, SAF Partners, which is one of the top VCs, made a killing from its investment in Make My Trip. The mother of them all, Walmart, acquiring Flipkart, happened this year. Richard talked about it also in his morning speech. That was a giant deal in India. It's probably the largest exit that VCs have made in India. And now VCs are so much part of the mainstream that even students, are getting classes in school about how to, become VCs in some of the schools that there are. And in terms of how the startups that the VCs have funded have fared, India did not really have too many unicorns till 2017. I think the number was about 10. But now in 2018 alone, year to date, there have been as many as 6 new unicorns added. And it is projected that by the end of the year, the total number of unicorns could cross 20 in India. So that's pretty huge. And that's a testament not just to the entrepreneurial ecosystem here and the quality of the startup talent, but it's equally, I think, credit should be shared with the venture capital industry, which has contributed to bringing this kind of growth and value appreciation in India. But it's not all unicorns. That's what the title is about. The cannonballs that we're talking about there are effectively the giant-sized bullets you need to dodge to make sure that your money doesn't go down the drain as a VC investor. And some of what we're going to be talking today with Suresh and with Karan is going to focus around those kind of questions. So, Suresh, may I start with you?
Sure.
Tell me a little bit about this whole history of Sama Capital. For everyone's benefit, Sama Capital was spun out of Silicon Valley Bank, which is a very, 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 very well known and deeply respected bank in the valley. So, what was the thought process behind the whole spin out of Sama, and how did that come about?
So, we had raised a first pool of capital in 2006, 2007, as Vijay indicated. There was a wave of firms that all got started. In some ways, that was the second wave with Draper International and a couple other groups making up the first wave. And we were in a fortunate situation. We had, I think India was in a good position. It was the investor community was quite supportive of new funds, and we were a beneficiary of that along with a few other groups. So we invested in 24 companies out of that fund. But as we all know, in 2008, the global financial crisis hit, and a lot of things changed, particularly for financial institutions. And SVB was no different. So they were no longer in a position to have the same structure. They couldn't put their name on it. There were other restrictions that were placed on banks. And in addition, our investor base, liked the fact that we had gotten started within Silicon Valley Bank, but also felt we would be better served by having greater independence. So that led to a discussion that ultimately resulted in an arrangement where, upon the first close of our second fund, which happened in 2012, we as a team would separate, form an independent firm, rebrand. We chose the Sama Capital name, and would ultimately have our own path as an independent firm.
Mm-hmm. Great. And what about you, Karan? What about the Bessemer story? Of course, Bessemer's been around for a very, very long time in the US. So what was the strategy and thought process when they came to India? Was it to do more of the same kind of investing, or did you have to take a different strategy to India in terms of your...
Right. So candidly, some of that stuff happened even before I joined Bessemer. So some of my answer will be anecdotal, but when we first came to India, we didn't really invest in companies which we would ordinarily invest in the US. So we were almost making a bet on the middle class, and at that time the thesis was that if you were betting on the middle class, then infrastructure, etc., would be good sectors to bet in. And we made a bunch of really interesting bets there. We made a bunch of interesting investments in healthcare. So that was a lot of what we did when we first came to India. I think after some time, and that would be around 2011, around that time period, a couple of things happened. Number one, I think the DNA of the firm is to be, for lack of a better expression, a tech investing firm. It invests in consumer internet companies, SaaS companies, new economy companies, not old world brick and mortar economy companies. So there was a pivot to generally do things which were similar to what the DNA of the firm was internationally. In addition, we had an interesting portfolio of investments in these old world economy companies and some interesting healthcare, which we of course continue to do. And then I think 2011 really saw some sort of a takeoff in India in this new economy space. And so for a variety of reasons, I'd say we sort of started investing in a different bunch of companies in 11, and that coincided actually with the shift of our office from Bombay to Bangalore. Because, so that's kind of the story. And since then we've been doing...
But would you say that the decision to invest in old economy companies and in growth stage companies is, was an aberration compared to Bessemer's historical strategy, or have you guys done that elsewhere
So
as well?
Bessemer is an old firm. So when you're a 100-year-old firm, I discovered that we funded a railroad company in the US.
Sure.
So I don't know if it's an aberration. It was a strategy which played out well. We'd actually made a bunch of interesting bets which are successful. But at that point of time, I think people felt like the real opportunity to make outsized returns was in this space.
Sure.
So I don't think it was an aberration or any regret in that sense. It's fine. We made good returns there, but you have to assess at any point of time, which are the most interesting places. And I
No,
think the game-
aberrations don't have to be regrets. Aberrations can make you a lot of money, but it's
That's true. That's true.
well,
But,
absolutely. Thank you for that. That's a good introduction to the firms, in terms of that. So, from your perspective, Suresh, how has the journey been? It's been what, 14 years now?
13.
13 years, yeah. So in the 13 years, have you seen some sort of a shift in the ecosystem in terms of maturity of the startups, or in terms of better understanding of deal terms and things like that? Or do you think that it is a constantly shifting landscape? I mean, how do you view the whole journey thus far?
No, I think it's been a great one. I mean, I think we've seen quite a bit in those 13 years. We've had global financial crisis in the U.S. We've seen, retroactive tax impact everybody. 2011, 2012, where nobody wanted to touch India.
Sure.
We've seen the rupee kind of rise and fall. We've seen, capital inflows increase significantly. So there's been quite a bit that's happened during that time. But if I take a look at kind of our world in which we operate here, I think you've seen a clear evolution in the types of companies. I mean, I still remember, having been an investor in the U.S. before focusing on India, I came in and the first thing I asked the team in Bangalore was, hey, show me your deal log. Show me kind of what are the type of companies that you're seeing. They put the deal log in front of me and I'm leafing through it. It's like call center, IT service company, call center. And then I'm thinking to myself, what have I got myself into? Sure. I mean, I was really like, wow, this is there's a long way to go here. But I think there's a clear belief that the ecosystem had all the makings and all the raw material that would ultimately turn into something great. And I think we've seen that. It continues to be work in progress. But the good thing is, I think the entrepreneurs and the members of the ecosystem, I think figured it out quickly, and also had the benefit of seeing what happened in the U.S. and equally important, if not more important, what's happened in China.
Sure.
So I think those are kind of things that helped accelerate how quickly the members of the ecosystem learned and kind of adapted to what we consider norms.
Sure. And what about you, Karan? What do you think? Do you think I know that you kind of got into this industry on the in-house side from 2011, and you were with a law firm prior to that. But how have you seen in the 7 years that you've been with Bessemer, how have you seen the market evolve or change significantly?
As a lawyer or generally?
Generally.
Okay, maybe I can answer this as a lawyer. I mean,
Sure.
anecdotally, it used to be funny. I remember when I first started practicing, and even when I first came to Bessemer, so that's as recent as 11, if you invested in Series A deals, and I think that might even happen in the off case now, you had founders who either just didn't read anything and signed up, so you could literally have a clause in the agreement saying, you'd have a put option with a 15% IRR at the end of 5 years, and you wouldn't read it and sign it. And at the other extreme, you'd have these guys who, of course, read, but were so unsophisticated that they would come back and say, what do you mean by reps and warranties?
Sure.
Just give me the money and I'll give you the shares and let's move on. So you sort of navigate through those two extremes as a lawyer, and you often find middle ground. In terms of process, I think Suresh summed it up well in terms of the kinds of companies, maturity of companies, the maturity of the ecosystem generally.
Sure.
Which isn't just necessarily the quality of the founders, but the law firms, the support system, bankers who bring deals.
Right.
The whole ecosystem.
Yeah, I mean, listen, it only happens because a community comes together.
Right.
And that's capital providers, entrepreneurs, and the service providers. You can't neglect that part of it because oftentimes, the companies are going to rely more on their lawyers and they are going to trust
Yeah.
the other side of the table, meaning the capital providers. So I think everybody's come together in a way that, we have a thriving ecosystem now. And, the amount of capital has, dramatically increased. I mean, a day doesn't go by when you don't see, a financing round of 50 plus million. I mean, it's just amazing the amount that's come in. And, 10 years ago, the idea of foreign capital outside of the venture capital funds that were spending time in India, money coming from China or other sources, nobody have dreamt of that. But now this is a global destination, and that's pretty substantial. Seeing that the ecosystem is still fairly young.
A lot of shift from the US capital to
Yeah.
Asian capital.
Sure.
I think 7 years back, if you needed a really big round, you wouldn't necessarily think of going to China or Japan.
Correct.
You'll go to China first now.
Exactly.
You go to China first. And that brings me to another interesting question. You're talking about China and Japan because of SoftBank primarily, but interestingly, Japan and China becoming big sources of funding as compared to the historical option of always calling the West. Now, that also prompts me to ask a corresponding question on the portfolio side. For the longest time, the Chinese companies couldn't get their stuff right on IT. India was always seen as having an edge when it came to IT. And now suddenly in the last 5 years, looking from the prism of being venture capital, working in venture capital firms, putting money in there, do you see suddenly that the tables have turned, that the Chinese startups have become more savvy and quicker at grabbing opportunities? I'd love to get your views on that in comparison to Indian ones.
I think I think it's certainly an ecosystem that's, I think more advanced, and I think has a basis where they actually are used to working with products and thinking about products as opposed to coming from a services orientation. I think, the tech environment here has really been driven by, great technical capabilities, but people come and bring, here's what we want to build, and people build it.
Sure.
Whereas I think the Chinese entrepreneurs, at least from my perspective, have gone out and, figured out kind of what needs are and have built it.
I think big picture, anecdotally, this is just, I was visiting New York last year and somebody just made this joke. It's in India, there's often these Me Too business models. You look at a business in the US and then you make the Indian version of it. And then there was this period where China did the same thing, and someone in America was joking that the pace at which China is going at, and that might just be a function of their economy generally. Americans are going to start looking at China and start making the American version
Of Chinese products?
Chinese companies. So in terms of scale, I think, they're really...
Well, not just in terms of scale, and also in terms of innovation, right? I mean, earlier it used to be that the Chinese strength was size, the Chinese strength was the ability to manufacture in huge numbers, right? But increasingly, we're also seeing fairly innovative businesses being born out of China.
Every aspect of their economy.
Every aspect, yeah.
Every aspect of their economy.
No, I mean, I think it is incredible, but they do have an unfair advantage.
That is true.
We shouldn't lose sight of
Let's
that.
talk about it. I mean, what is the unfair advantage? Just for everybody's benefit, I think the unfair advantage Suresh is talking about is the fact that the political systems and legal systems are different in China and India. It probably takes much more bureaucracy and much more effort to push things in India than it does in China. But on the flip side, I want to ask the question, is that a genuine difficulty, or is that an excuse that we've been giving out for too long in India?
Well, also the other, to me, the unfair advantage is the government has protected, the ecosystem. I mean, you don't have Google, you don't have some of the companies that the rest of the world has to compete with.
Sure.
And that, I think, gives them a significant opportunity to grow without, the highest level of competition.
Sure. Well, I mean, that's a fair point. But my only counterpoint to that is, are we hiding behind that excuse for too long? Should we, maybe our Indian companies just need to figure it out?
No, absolutely. They do. They do.
I think that's a factor, but I don't think anyone thinks that's the only reason
that they're ahead.
there is the kind of
Fair
difference
enough.
sort of developed over the years.
Sure. And in terms of the type of, sorry, I'm sorry, I'm going to just hold on to this. So I'm also going to talk about the regulatory framework for a minute, and what has been your experience, both your firms, in terms of looking at doing deals in India? Has it been getting progressively easier? Have regulations become more sane, or have they become more insane?
I'm going to go with the latter.
Okay. And why do you think so?
You know, it just seems like at every turn things are being made more difficult. Despite India kind of rising in the ease of doing business surveys, I have no idea which India they're talking to, but it doesn't seem like the one that we're operating in.
Okay. So what you're saying essentially is there's a lot of good intent, but it's not really getting translated to the business end of regulation.
Yes, the talk is very different than the reality.
Okay.
I just describe it as saying that any regulation in India is often, even at the most, like, without doing a very high level analysis of it, even if you just look at it very, very simply, it's often drafted so poorly that even if you have a reasonable sense of what they were trying to achieve, which is probably not altogether bad,
Sure.
it can be drafted in such a, I don't know how to put this, suboptimal fashion that you then need to have conference calls with 6 different lawyers, get 12 different opinions, and at the end of it all, still not be sure about what the consequence of this could be 6 years later when you're trying to sell the company. Because at that point of time, you know, there may be a 10th law firm which takes a different view, and then you're screwed when you're trying to sell the company. So that's a real challenge if you think about the regulatory framework.
No, even, you know, there's, you know, one particular issue that, you know, I think we've talked to 6 or 7 different law firms. You have 3 on one side and 4 on the other side, just because it is this lack of clarity.
I mean, just take this isn't necessarily directly the question you asked, but something which is very fundamental to all our transactions, you know, this liquidation preference concept. And a lot of people do a number of deals based on preferences, participating preferences, 2x preferences, senior preferences. If you really try to enforce any of these things in a situation where someone even puts up some mild resistance, it wouldn't take a lot of resistance to make all of these provisions very, very difficult to enforce.
Sure, that's a fair point. And I just want to make sure that if anybody has any questions on some of these things, on liquidation preference or anything else, feel free to stop us. Like I said, let's keep it interactive. We don't have to wait till the end for the Q&A. But that's an interesting point you make, Karan, about liquidation preference, because that is a personal, pet peeve of mine, because I have seen many funds spend a disproportionately high amount of time trying to negotiate a 2x liquidation preference, apart from the fact that it may not even be enforceable in various circumstances. It also seems a little counterintuitive to ask for a 2x return when you're asking for a downside protection like a liquidation preference. I'd love to have your views on that.
Want to go first?
Sure.
No, I think it's fine. It's a commercial transaction. It's a function of the valuation. So sometimes you get to a certain valuation by negotiating downside protection, and I think that's fine. You can negotiate any terms which are appropriate. I think what's difficult for funds is they're so used to setting deals up in this fashion, because that's how they've been done historically in the US, and most of these funds have some sort of origin from there. That I think some people may find it difficult to reconcile or to take into account or appropriately price in the fact that these provisions may not necessarily hold up to scrutiny if they're challenged.
Got it.
I think that's really, to me, as a...
So you're more concerned about the regulatory enforceability and not the commercial fairness or rationale behind the whole thing?
Not really. It's so standard, and it's a function of valuation. I mean, I'm happy to give up my preferences if you're happy to take a 20% discount on the valuation. You know, it's just different financial tools to get to a certain number. That's the way I look at it. I don't know if you have...
Yeah, so I have a little different view, and this is more maybe the a little more commercial and practical view from early stage. You know, once you set that 2x liquidation preference in place, in some ways you set a benchmark.
That's true.
And then, you know, the next guy's going to expect it. And what ends up happening, you have these stacks of liquidation preference that ultimately buries the entrepreneur who you're ultimately relying on to drive value. And once they start looking up and saying, geez, I've got to clear this, and then this, and then this, it becomes a significant obstacle.
That's true. So the way we look at it as a fund, just specifically, is that the earlier you come, the cleaner the terms. But if you're coming in a late round, high price round, you may want that sort of protection. But yeah, and a Series A, 2x preference isn't a clever thing to ask for.
I mean, we have one where it was part of the deal, and honestly, it's been an obstacle every single time there's been a capital conversation.
Right.
Because everybody comes in and expects it.
I've seen that as well in at least 3 deals this year that we have been involved in. We have seen this become a huge millstone around the neck because, like Suresh said, it ends up setting a benchmark. And what's become worse is the later stage guy wants a seniority. He wants to create a waterfall. So the Series B wants to be superior to Series A. And so if a Series B guy gets his 2x, there's nothing left for anybody else. Right. So it's becoming a bit of a problem.
I mean, there's a famous example.
Oh, I'm sorry. Can we just, we have a question there. Can we use the?
I think he's trying to.
Can you give him the mic, please?
Hello?
Oh, there it is.
Just to follow up on the liquidation preference and the 2x, because I'm from the States and we have the same, conversation in many deals. And sometimes you see as a compromise that you can have your 2x or 3x, but that goes away once the sale price exceeds X, or once your total return exceeds Y, the 2x, 3x super preference goes away. So you got your protection early on, or up to a certain level, but once you just kill it, it goes away. So that's what we sometimes see as a compromise to reconcile the conflicting interests. I wonder if you have the same approach in India.
Well, we've done that with participation features. We won't do it with 2x. We'll have the participation feature go away once we're above a certain threshold return.
Yeah.
Exactly. That's what we do. Even though we try to avoid participation.
Yeah, I mean, we try and keep it clean.
Exactly.
Keep it clean.
So generally, Fred, to answer your question from a purely legalistic standpoint, in our experience, it's very non-customary to have a conditional liquidation preference. It usually goes in as an unconditional right. The only way to dilute it is to negotiate it out of the SHA, the shareholders agreement.
Right, and just as a factual, so there are very limited circumstances where we've seen preferences actually kick in, because if preferences kick in, that means management is getting nothing, the deal's not going to get done. So you end up negotiating a carve-out, which often ends up close to being their pro rata share.
Yep.
That's just how the commercial negotiation ends up. And if you're looking at participating preferred securities where the preferences will sort of kick in even in high price exits, people are generally happy. Again, if you tell the management team, I'm going to enforce the participation feature, then it might just make getting the deal done a little more complicated. People tend to. So I agree. There's, maybe it's a big ado about nothing, but it's pretty standard in documents.
Sure.
In India.
Absolutely.
Not the participation feature, but the clean 1x.
Yeah.
Clean 1x is,
Clean 1x preferred
Absolutely.
is what I would call market.
Absolutely.
Listen, I think ultimately you want to have your returns come from the company succeeding. If that happens, then all the other structuring really doesn't matter.
Absolutely.
And some of these e-commerce companies have raised so much capital. There's a company, I think we both know, which has raised well in excess of $1.5 billion.
Right.
And even if it was being sold for $1 billion, everybody was getting back 50%,
Yeah.
50 cents on their dollar, and the founders are going to get nothing. And that creates its own issues.
Yeah.
And those kind of deals just don't get done. And
So you end up with zombie unicorns? Is that what happens?
People try to forcefully convert
Right.
all sorts of stuff.
Okay.
That's when the lawyers start making money.
Sure. So let me ask, Karan, you this question. Specifically, if you were to list the top 2 pain points that you see in executing VC deals in India as an in-house lawyer, can you share them with us?
It's a tough one. Top two pain points. I mean, it depends on the stage at which you invest in. So I think Series A, B deals aren't necessarily very difficult to execute. I think they just get done. I think if you come in a Series C kind of situation, you often find shareholders agreements and other documents which may not necessarily match the expectations that you have of certain documents, and then sort of changing them at that stage isn't necessarily something very simple to do, because as Suresh pointed out, once certain things get written in, they sort of tend to stay there.
Sure.
So that's one challenge. I mean, I think that's the main one. I could get into specifics around different provisions in the agreements, but I mean, I'm just speaking from the perspective of a lawyer.
Sure, absolutely.
I guess, there's always the question of getting the right value
Of course.
to make a deal happen.
I have a couple of questions for Suresh on that, but it wouldn't be fair to ask him a question about legal issues, though I'm sure he would be fairly familiar with the legal issues too. So, so what about you, Suresh? What would be the top one or two things you would watch out for? The cannonballs that we're talking about. Everybody's putting money in the hope that your investment is going to become a unicorn, but what are the cannonballs that you want to dodge, the top 2 or 3 of them?
Yeah, honestly, I think about it more, more company specific rather than kind of macro.
Okay.
It's making sure that you have vetted the founders and you're working with good people. I mean, I think we all have portfolios large enough where, we've had, fraud happen. I mean, it's not something people like to talk about, but all of us have experienced that. If you haven't, then you obviously haven't been around for very long. So I think that's one of the things. And I think honestly, I think the current crop of entrepreneurs, they largely are very straight, understand that they have a reputation and honestly see a career beyond this current company. And I think do a pretty good job of keeping their noses clean and abiding by all the compliances and being a good an honest business person and understanding that it's not an adversarial. Certainly there are adversarial points during the relationship between an entrepreneur and an investor, but once you get past that that first Series A round, everybody's in the same boat. As we like to say, unless the entrepreneurs become fabulously wealthy, we only have we don't get a chance to be even a little wealthy.
Right.
So it all stems from making sure that we're aligned and we pull towards that kind of brass ring, if you will.
Sure. But do you find generally resistance from entrepreneurs is a big friction point? What I mean by that is entrepreneurs are not just very smart people, they're also very dominant and controlling personalities very often. So do you find, and we've had, without taking names, we've all seen some very prominent examples in India of great companies going down the drain because of what I call entrepreneur management issues. So do you, do you perceive that as becoming a significant issue in India going forward? Because one thing that I'm hearing a lot of VCs kind of subconsciously complaining about is they talk about companies which raise a certain level of capital, they start getting into this whole belief of being invincible, and that makes the entrepreneurs less inclined to listen to or take advice from or even consult their investors once they cross that stage. And they maybe start obsessing with unicorn status. Whether that itself, whether unicorn status should be an end in itself is a separate question. But we have seen examples like this. So I would like both of your takes on how your firms, what are your strategies to manage entrepreneurs' personalities and to make sure that relations are harmonious and respectful?
I think that's part of the vetting you have to do at the beginning. Make sure there's a common worldview on what are we trying to accomplish here and how do we get there. Because listen, the dynamics do change over time, but particularly companies that raise huge amounts of money. The guys that give you the most money at the highest price are the ones that you're going to ultimately listen to. And for us, that's a dynamic, fairly easy to see starting to change. And oftentimes, rather than fight it, that's the time to look for an exit.
Sure. Sure.
Listen, now, if that happens, the company's done well. And there's a good return, there's a good opportunity for the early investors certainly to get out. So try and move forward on something like that. But I would say we haven't had too much difficulty with that, just because I think hopefully we are fairly active and engaged with the companies from the time we invest and even before. So hopefully there's a relationship built on trust and respect that carries through for the life cycle.
Sure, sure.
It's not 100%, but I think by and large that's the way it's worked for us so far.
I agree with that sentiment completely. Sometimes negative news tends to grab headlines, but I think on balance,
it's a very small percentage.
Okay.
Exactly.
Very, very reassuring to hear that from two of the VCs who've been here for the longest time in India.
No, I mean, I think there are guys that have reputations, and you kind of, based on the interaction, you can tell some of the traits.
Sure.
And we, pardon my language, we try and follow a no asshole rule.
Understood.
Because life doesn't get easier once you're an investor. Life only gets more difficult because of the bumps in the road.
Sure, that makes sense. So you have a question, please. Use the mic.
Yeah, I wanted to ask, just as you raised the question of, entrepreneur attitude, and, it at times becomes very difficult. So, and we were also talking about a comparison between India and China startups. So, the amount of funding which is going on into the market in comparison to India and China, where do we see what is the most risky proposition in the terms of, where the money just goes down the drain and people just shut it off and there's no return in comparison to both the markets?
I don't know if I necessarily have any data to base my answer on. I don't know, I suspect the miss rate is not very different in both countries. I genuinely, I don't know enough about the China market.
Nor do I.
The likelihood of losing capital there relative to India.
Sure. I mean, is your question centered around, are the legal systems more set up to, such failures? Is that your question? Or are you talking about the economic aspect of the markets?
Aspects to it, right? So one is, we are saying that there's a lot of products, and China has been doing a lot of product development from the past. If you go into China, you will not find a lot of IT services companies like Wipro or HCL and things like that. You will find a lot of them here because that's how we have grown into the IT space. And now people are going into the product space with startups and product companies. So one aspect is that, whereby, people have a tendency just to raise the funds, invest it somewhere else and run away. The second thing is that, from a legal perspective also, where it is much easier to catch hold of those loopholes, right? In both the countries, I mean here or...
So let me answer the question this way. I think China probably does a better job of catching the loopholes and catching the defaulters, because generally I think once they decide to do something, they do it pretty quick, the government, right? And they have the resources and the wherewithal to make it happen. Whereas India historically has had a great legal system, great set of laws, we have a common law system and all that, but our enforcement historically hasn't been great. But I would say that it's changing now. I think India is slowly adopting global standards, and when it comes to, going after the defaulters. So I think it's a matter of time. But China is always going to have that little bit of unfair advantage, like Suresh said, because the government there is able to make things happen much faster because of the way they are set up. Does that answer your question?
Thank you.
Any other questions on this, or can I move to the next topic with them? So I want to understand a little bit, Suresh, about how do you plan for your exit? Do you start that process even before you put in your money, or is it sometime? Can you just walk us through the process that you follow, or the general approach that you follow for planning for exits?
I think there's a lot more wishful thinking around planning on exits in the private markets than kind of can actually be done. I mean, you certainly, as you're putting forth an investment thesis and writing up your investment memo, there has to be some thought given. But again, when you're in a company as an early stage investor for 4, 5, 8, 10 years, the world changes over that period of time. So I haven't done this, and honestly, I'd be afraid to do it, to go back and say what we expected, what we thought was going to happen at the time of investment, and what actually ended up happening, and who we sold to, or whether it listed. It would be an interesting exercise, but I think our view is the opportunities can be fleeting to exit private companies, and there's, I think, very little opportunity to kind of plan for it. You just have to be ready if you see an opportunity that you push hard to try and make it happen. Whether it's a secondary transaction or an M&A opportunity comes up. Obviously, if it's a IPO that does need planning and time and effort, but up until recently, the IPO market here has not been particularly receptive to emerging companies, and that's changing.
But would you, for example, going into an investment decision in your investment committee meeting, would you look at who are the likely buyers for this company 5 years down the line?
Sure.
Would that be a part of the investment analysis?
Yeah, it would be. No, you definitely would give thought to it.
Sure.
But in some ways, it is a thought exercise.
It is a thought exercise, yeah. What about?
I think the one thing which Suresh said is key. I think the exit opportunities are fleeting. So sorry, just to answer your question sequentially. Obviously, there's some thought which goes into it when you make the investment. But I think you described it well. I think once you're in the company, exit opportunities are fleeting, and I think the challenge is to sort of take advantage of the opportunity when it presents itself. Because I think M&A activity in India, relative to other economies, is probably lower than it ought to be to have a healthy exit environment. And on IPOs, there are two things. One is the IPO market itself hasn't necessarily been receptive to these kinds of companies. Leave that aside, IPOs in India don't always generate the kind of liquid trading that may happen in overseas exchanges.
Absolutely.
So you often end up owning not trivial positions in these companies, and there's just no one there to buy them.
Sure.
And it would be very interesting to see how many of these stocks trade down from their IPO prices. So a listing isn't necessarily as much of an exit event as one would always want it to be.
Absolutely.
Well, I think everybody talks about IPO as the end all and be all. But listen, if you company can't use it for financing, and you can't use it for investor liquidity, it serves you no purpose.
Correct.
It's in fact bad.
It is.
It's
an albatross.
reporting your numbers every quarter. If you don't hit those numbers, then your stock starts trading down on very little volume of trading, and it's just a negative spiral. And then raising money in a listed company is a
Well, sometimes even if you make your targets, your stock price, slides for reasons that have nothing to do with fundamentals, right? And that is a problem with the stock market. And the one other point I would add to what they're talking about why IPO is a bit of a tricky liquidity event in Indian market is our regulations require a 1-year lock-in of shares, which means that all pre-IPO shareholders are, locked into the company. They cannot sell their shares for a period of 1 year after the IPO. And there have been many instances where companies have had very successful IPOs, but in the 1 year from then, the share price has tanked for reasons that doesn't necessarily have anything to do with the company. For example, there could be some global catastrophic event which drives down stock prices, and that is the most helpless situation from an investor's perspective, because technically he's got a liquidity event as per the documentation, but he's not able to sell the shares, and by the time you can do so, the stock price is beaten up quite badly.
That's a great example of over-regulation. I think most sophisticated markets leave it to bankers to have contractual lockups with existing investors.
Absolutely.
And I think this probably made sense in whichever year it was introduced in, because maybe there was no critical mass of IPOs in India and the market needed, lockups to be forced by the regulators. But frankly, I think Indian market is probably sophisticated enough now to move to contractual driven lockups, which just are more sophisticated,
Sure.
make more sense. You can waterfall the number of shares which come onto the market over a period of time rather than this 1 year cliff, which, and then we have this investors being classified as promoters, which is another
Big issue.
crazy that you could call an investor promoter
So just
and lock
for
him up for 3 years.
just for everybody's benefit, promoter is basically usually the founders or the controlling group of shareholders in a company. Indian, IPO regulations require that the founding group's shareholding in the company is locked in for 3 years, not even 1 year, it's locked in for 3 years from the date of the IPO, to the extent of minimum contribution, which is about 25%. So, as Karan says, that's a big hold-up factor as well for, strategic activity after a company goes public.
Right. Especially because the kind of businesses we invest in often end up with founders owning less than 20%, which is the minimum, contribution you need to make to this 3 year lockup. And the regulators, instead of changing the rules, responded by saying that the investors should then offer up their shares to get to this 20% number and actually classify themselves as the promoters of the company, which involves some level of disclosure, which I think is probably manageable, but it just makes very little sense from a ecosystem perspective.
Sure.
Say somebody must be locked up for 3 years. I don't see anything unique about Indian markets relative to the rest of the world where you need to force this rule on us.
Sure. And, given the RBI's, Reserve Bank of India's confusing positions with respect to put options in contracts, do you all still have put options in your deals, in your SHAs? And if so, do you ask for put options with guaranteed IRR? How does it work?
No.
You don't?
We have a buyback sort of thing, which is the company buys back the shares at FMV.
Sure.
If a drag doesn't work, if an IPO doesn't happen, in which situation probably the company is just going to shut down. If no one's ready to buy it, if it's not going to list, company unlikely has any money to buy you back. So it's a theoretical thing there, but definitely no IRR and definitely not in the promoter.
Sure.
Yeah, I think it's similar circumstance. One of two scenarios: either the company's doing poorly and they can't buy you back, or the company's doing well and you don't want to be bought back.
Sure.
Exactly.
So, in almost 25 years of this, I've seen no redemptions, and I've only seen it used as a leverage point to, force an event.
But what about the use of rights like drag-along rights? At a philosophical level, are you in favor of having rights like that if you don't get exits?
Yes.
Within a,
It's absolutely.
You have to have it.
Sure. And what kind of a time frame do you typically ask for drags in?
5, 6, 7
Yeah,
tends to be
I
the range.
don't think it's anything less than 5.
Right,
Okay.
right. I think the challenge is when you come in at Series A with 5 and then Series G wants 5 more.
Yeah.
Then you're done.
Have a interesting discussion.
Well, it's not Series G who wants 5 more. It's the founder who wants 5 more from the Series G.
Often Series G just wants 5 more because he doesn't want to be dragged.
Sure. Absolutely. Okay. So I'm going to ask you a bit of a out-of-the-box question to take it away from the legal side for a moment, right? The legal stuff is getting a little too intense here. So tell us about the Bessemer anti-portfolio.
So I don't know if any of you have ever seen our website, but it's probably the most useful marketing tool that was accidentally discovered by some partner of ours many years ago, because it's been there for a long time. But if any of you have free time, you can go to Bessemer's website. You can check out our anti-portfolio. It has all the companies which have since turned out to be wonderful investments for other funds who had either sought financing from Bessemer or Bessemer had actively tried to fund them and then finally chosen not to. So we call it our anti-portfolio, and it has some fairly successful
Companies.
names on it. And it's actually that link is probably the most visited thing on our website.
And when you read it, you will understand why, because it's very humorously written also. and it's very tongue-in-cheek. The one I personally love is the one about how they passed on Google.
Right.
And he said, internet search, can you please tell me how to get to my car without going anywhere near your garage? That's what the Bessemer partner said. Who was that again? Was it Ed?
Was David Cowan.
David Cowan. Yeah.
And if I'm not mistaken, I think the founders started up in a garage in the home of
I think
either
Susan.
some relative.
I think it was Susan.
I don't remember who it was,
Yeah.
but he had gone to their place and they said you should meet these young kids. They're really smart. They're setting up a search engine. He was like, just let me get out of here without meeting them. There's similar stories around Facebook.
Yeah.
So.
And what about you, Suresh? Does Sama have an not listed, but does Sama have an anti-portfolio that you can share with us?
Yeah, honestly, I think I don't think we necessarily have an anti-portfolio, but there are ones which I shall not name that we were very glad that we didn't do. In some ways, we take the approach, some of the best investments we made were the ones that we didn't do.
Right.
So ones that, we said no to and ultimately, or came very close to doing and then said no, and then.
Oh, those are the giant cannonballs that you dodged.
Yes.
Yeah. So you have a dodged cannonballs list, you don't have an anti-portfolio.
Yes.
Okay. Or maybe you won't share the anti-portfolio.
We won't share
with us.
that.
Okay. All right. So tell us about the sectors that you like and want to invest in India.
So I think by choice, we've had a fairly broad view on kind of the opportunity in India. We like both tech and non-tech, and we've been that way since we got started in 2006. In terms of categories we like SaaS software. We like financial services. Having come out of Silicon Valley Bank, it's something that's we're quite familiar with and comfortable with. We do like consumer, meaning consumer products and I guess what they call FMCG here. We like that, but we clearly are not limited to that alone.
Sure.
I think are constantly asking ourselves, okay, maybe some of the things that we haven't done in the past, let's go back and revisit.
Sure.
Are the assumptions under what reason why we didn't do things in the past a reason to continue potentially shying away, or does it, dynamics change now where we should be more open-minded?
Sure.
So I think that's a conversation we're always having.
Understood. And what about Basma?
I mean, I gave you a brief. So we look at consumer internet, fintech, SaaS, technology-related companies, products, that kind of stuff. We wouldn't be doing so much. We wouldn't fund a railroad terminal anymore, which we have done in the past.
Sure.
Even in India, incidentally.
Oh, you've done that in India?
Construction.
I know about the power company. I don't know about the railroad.
We've done power companies in India. So we wouldn't be doing those kind of investments at this point. But
Okay.
closer to the DNA of the firm globally.
Sure. But given that we have here an audience of lawyers from around the world, I think Bessemer, of course, is active in a few markets other than India, several markets. But what about Sama? Is your strategy limited to investing in India? Do you do deals, say, in the US or in Israel and countries like that?
We won't do Israel. I mean, everything that we would invest in has to have an India connection.
Sure.
They'll largely be based here, but we will look at some opportunities that are cross-border, primarily with the US.
Sure. Primarily with US. Okay.
And those will be more technology product opportunities.
So basically companies like Mezi,
Yes.
which turned out to be a pretty good bet for you. Yeah. And so was it like a 2-year harvesting period for it?
18 months.
18 months, yeah.
But actually, that's one where you asked about exits. That's one where I think we had a fairly, informed sense that the buyer would be American Express because they were a strategic investor in our round.
Sure.
So that would be high up on the list in terms of likelihood, and it ended up going that way. It just happened much sooner than we expected.
Okay. So one slightly awkward question for both of you. I'm sure you have realized this and noticed this in the Indian market. In the last 5 years or so, in particular, there's been a surge of new funds being set up by Indian GPs. And funds raised from Indian LPs and also from overseas LPs. But what I'm saying is pure play Indian funds, are they increasingly becoming a threat for you? Because for the first 15 years of your investing existence in India, you were virtually unchallenged because most of the investment money came from the US. And now, as you've already noted, part of the money comes from China and Japan. But what about India? What about Indian funds which are like pure domestic AIFs? Are they a serious threat to you?
I mean, it's, to us, in some ways, the structure doesn't matter. I mean, VC is kind of an interesting industry in where at times you're collaborating and at other times you're competing. It's just another structure through which capital is provided to companies, and they're coming through domestic sources, which, while it's relatively new, some of the GPs that were formerly with global firms or were investing out of a non-AIF structure now doing it with an India structure. So the capital, the structure through which the capital flows is different, but it's still the same GPs.
It's probably a good thing, actually.
I
There's
think
more
it is
capital
too.
in the ecosystem.
It's very good for the startups, undoubtedly, because it gives them more options. But
It's good for your portfolio, right? If your portfolio has access to more capital.
it is. But the
so
point
it's
is,
pros and cons.
let me give you an example, right? Let me give you an example of why this could be a concern. Very often these days when we are doing multi-party, multi-investor deals, we are seeing this little friction, which is what I will call regulatory arbitrage. The Indian guys don't have the restrictions that you do on exchange control and stuff like that. So if they ask for a liquidation preference of 2x or a guaranteed return of whatever, and you are not able to do that, that's a pretty significant right that they can get and you cannot get. So I'm talking about situations like that. Have you started seeing that in your portfolio when they're fundraising or when you're looking at getting into multiple? You're not in your.
No, in some ways you can't have that amount of differences in terms with people coming in at the same time. We're all, if we're all supposed to be in the same boat,
Sure.
we all have to share the same terms.
No. So what happens if you came in at Series A and there's a Series B investor coming in and negotiating a put option with 24% IRR?
Then your company must have not performed very well to only have one choice.
Right.
Sure.
The market is speaking.
Money, yeah.
Sure.
The market is speaking.
It's not a regulatory thing as much as.
Fair enough. No, the regulatory thing is not driving the decision, but it's hindering the process.
Okay, maybe this isn't necessarily directly answering the question, but I suspect if you had access to foreign capital which couldn't get that term, then they'd probably come on some other term which was equally punitive. Maybe a lower valuation, or they wouldn't necessarily take on less or more risk,
Right?
because of the regulation.
Because of the regulation. Yeah. You had a question, Fred? Sorry, can you, if you don't mind, can you give him the cordless mic? Excuse me, cordless mic.
So when you're talking about the structure of the supply side of capital, and you've talked about foreign funds, now you're talking about domestic funds. Is there another source of capital in India, just from wealthy families, and the beauty of wealthy families, particularly from the U.S. standpoint? Bessemer certainly was a wealthy family in Pittsburgh. Is longer term holding period. Certainly venture capital sometimes takes a long time, particularly if you've got a lockup and then you've got a fund with a limited life based on the nature of the structure of funds. So you're seeing more and more wealthy families as a source of early stage capital because they can be more patient and they can be more long-term oriented. So are you seeing that as a competitive part of your ecosystem?
Sure.
Few family offices. I'm not sure if it would be. I don't know. I don't again have the data in relative terms, but I suspect family offices are more meaningful in the US than in India in the VC ecosystem. There are a few family offices in the India ecosystem, but
I think by and large, I don't see them kind of operating on their own. They may come in as part of another round and deploy capital that way, but at least I haven't noticed much in the way of family offices kind of serving as a sole VC and leading rounds and taking a more institutional perspective.
Yeah, the only family office which probably leads rounds is Premji Invest.
Yes.
And they are
Right.
they
But
are very, very,
I suspect what happens even with them is they end up co-investing with a bunch of other funds which have all these timeline issues
Sure.
anyway. So for the company, while you might have one investor which is maybe in theory more patient than a bunch of the others, a lot of the decisions still get driven, a lot
by
of
the
the
VCs.
timelines you would expect of
But
traditional
Fred, is your
VCs.
question about early stage or about slightly later stage? Sure.
Early seed stage, note stage, up to the, you mentioned G round, but throughout the whole spectrum,
Sure.
I'm just wondering, are there predominance of
So
families?
I would answer it this way, that I would say that certainly pre-Series A stages attract a lot more family office investment. And in the post-Series A and above, family offices do participate, but as a part of a round, along with other institutional investors. But family offices doing solo rounds or leading rounds usually happens in pre-Series A in India. More of it happens.
I don't know if this answers the question, but I don't think companies perceive going to family offices as advantageous because the capital is more patient.
Yeah.
So it doesn't necessarily give them a competitive edge in the market because I don't think there's a critical mass. There's no company which is going to get funded only by one family office or a collection of family offices. They'll end up
Absolutely.
speaking to venture firms, which have traditional sort of requirements in terms of exits, etc.
Although Binny Bansal may prove us wrong in the coming years.
So yeah, but I think the reason why also I would say family offices in the later stages are not very attractive to pursue is the venture capital funds bring their own, they open their own doors. Yes, some of the family offices have contacts, have a great amount of clout, but I think historically venture capital funds have more track record, demonstrated track record in opening doors for companies. So for all these combination of reasons, they tend to be more seen in early stage rather than in late stage. Shall we continue?
Can I just add, on that topic, what is the length of your fund, each of your funds? Is it, in the US, they're typically 10 years and then maybe some extension for 1, 2, 3 years after that? Is it the same thing with your funds or the structure of the funds in India, or is it somewhat different?
Yeah, ours is the same as the US.
Right. And we actually invest out of our US fund. We don't have a separate India fund. It's a global pool of capital. So
Okay, so one, coming back to boring regulatory enforcement type issues, I'm just mixing it up so that we can talk about it without going to sleep. Do you find generally that timelines of transactions have increased in recent times? Have deal execution, documentation and the process and the timeline become more complicated over the years?
I don't believe so. I mean, I think you will have things slow down if you have a party that isn't as experienced.
Okay.
But that's not because of regulatory. That's just you have somebody that's not as experienced.
But you don't think the regulatory framework in India has become more complicated over the years that you operate?
It has, but I guess it just seems you have the right legal counsel, and it just gets taken care of.
I think it was.
You can probably give me a more, less politically correct response.
You know how our firm works.
Yeah.
So
I rarely get involved with that.
Yes, absolutely.
I think maybe so on timelines, people might be a bit more. So for a variety of one, maybe people have burnt their hands. Number two, I think people are getting more sophisticated. So people maybe spend a little more time and are a little more thoughtful with documentation. And I don't necessarily mean just the investors. I mean the founders. They probably are better lawyers. They probably spend more time trying to understand what they're signing up for, which might have contributed to things taking a little longer. I don't think it's meaningfully shifted the goalpost. Maybe a bit longer.
Sure.
On the regulatory framework, I think there are some regulations which have gone, there are new ones which have come in, so it's a constant ongoing challenge to navigate the rules,
Sure.
which is, I suppose, good for people in this audience may not be so good.
Very good.
If we were in a very different audience.
Yeah.
Yeah, I don't know if that answers.
No, it does, it does. But I'm also looking at it from point of view of LP perception, right? So as we all know, a few years back, the Indian government did a series of missteps, took a series of missteps. For example, the attempt to do retroactive taxation on what the Vodafone case, the Vodafone deal. So around, as a result of all that, there had been a period of time when LPs were a little hesitant to commit funds to.
You're being awfully kind.
I am.
Having raised our second funder in the midst of that, hesitant would be an understatement.
Sure. So I'd love to hear about how the situation has changed now. Are LPs more bullish on India? Are they more easy to talk to? Is it easier to get their attention now and their money?
It is. It is. I think in some ways India has proven itself out, and I think this, some of these, anti-business or kind of regressive policies were under a prior government, and that government change has happened. I think there's been, some good things and some, things that are questionable. But all in all, I think the investor community believes in India as a long-term story, and the sentiment's been very positive, certainly for 3+ years.
Yeah.
And honestly, for us as a smaller firm, unlike I think a more established firm like a Bessemer, where you have an LP base and they traditionally stick with you. Sentiment matters a lot if you're taking country-specific risks. And so if India is seen in a positive light, then the investors also kind of fall behind that.
Absolutely. What about Bessemer's view on this or experience on this?
I mean, like I said, India is one part of the global fund. So I don't think our LPs decide to give money to Bessemer, based.
But do they try to influence allocations to India?
Oh, so the fund is a global fund. So
Sure.
we don't have an allocation to India.
At
So
all.
No, nothing. So which means that there's no cap on how much you can do and there's no floor.
Sure.
You need to find a company which, in theory, is of a standard which would, be as good as one in California.
Sure.
I mean, because there is no capital which has been separately kept aside only for India. So,
Got it. Understood.
it just
Sorry, go ahead. No, I was going to say that, so the comfort essentially is that you don't have to go back to the LPs once you've raised the funds in terms of where you allocate how much.
Yeah, I mean, I don't know if I'd describe that as a comfort. That's just how the fund is set up. But having said that, naturally there is a firm view. Obviously, when the retroactive tax was put into place, that was just not a good time. But
Sure.
the last 3 years, it's funny because I was thinking the exact same thing. Even if you look at the return profile for funds, there has actually been some steady momentum in exits. People have actually been able to demonstrate that you can make money in India, which was not necessarily true 5 or 6 years ago.
Right.
But that's changed a lot in the last 3 years. So I think there's, general positive sentiment.
Sure.
I think between exits happening and cash going back, I think the size of the exit values has gone up. So I think there's a much stronger belief, or even in the round side, the values of rounds, you can actually see more zeros.
Right.
And as a result, the LP community is saying, okay, now the story is starting. We've always believed in the demographics. We've always believed in the long-term potential, GDP growth. Now the investment thesis part of, big outcomes leading to big returns back to investors kind of finishes the picture.
That's actually been helped by SoftBank,
Absolutely.
Alibaba.
Hugely
Asian
helped by,
funds. Yeah, they're the ones who've come in with these.
Big checks, yeah? But talking about the big checks, I think that's a great point that both of you raised. The big checks are actually giving some serious gravitas to the whole industry and the whole ecosystem in India. But the counter question that it raises is there a lot of capital that's getting dumped in the Indian ecosystem? Too soon, too much? And is that always necessarily good? Is that sometimes subsidizing not so great companies and helping them survive beyond what they should be surviving? So what are your views on that?
To me, as a small fund, we always like capital efficiency. You can get bigger, hopefully you achieve more with a smaller amount of money, and the multiples, which we're in the multiple investment game.
Sure.
I do have concerns about the amount of money that's coming in and being able to get the multiples on, fairly sizable amounts of capital. And, there are obviously the Flipkart stories, and there's a couple of other ones, but, you haven't seen the volume of really big realizations.
Sure.
You've seen illiquid or, mark-to-market type valuations, but those are paper gains, not real gains. So I do worry about, can the paper gains be translated into cash back to investors? Because
Sure.
ultimately that's how they evaluate the market and us as managers.
Absolutely.
I mean, I agree with that. In fact, that's not the question you asked, but just on this paper gain thing, we've also, maybe this is anecdotal, but companies can raise at X, but if you try to get secondary done in the same company, it's unlikely going to get done at the same value.
Sure.
There's going to be some discount, often meaningful, which is not a good thing or a bad thing. It's just,
Sure. So tell us about why don't you each talk about one or two of your successful exits? Just share your experience with us.
You want to go first?
I mean,
So that you get time to think. Which ones?
No.
There's a cheat sheet there for you.
of the many.
I mean, these are just some exits that we've just put in my presentation, but quite clearly, both Bessemer and Sama have had some hugely successful exits in India, so I'll leave it to them to
I mean,
talk
IEX
about.
is a great example. That was a business which was super regulated. There was, I mean, it's so funny. It's difficult to give you all the context unless, I spent 45 minutes trying to explain what happened there. But just one snapshot. The government came out with a regulation which was, which had the heading "with a view to liberalize," and then it introduced 5 points, all of which were anything but liberalizations. It was actually comical because when I was discussing this with my colleagues in New York, it was difficult for them to understand how this could start off with a view to liberalize and end up creating these many
Confusions.
issues for us. But that turned out okay. Of course, I'm sorry, this is not one of Bessemer's, but I think they did a great job with Snapdeal.
It's, you can look like a genius in hindsight. And we'll continue. We'll be happy to carry that logo for a bit. But no, I think, interestingly enough, a lot of our exit activity has been at the benefit, with the benefit of secondary transactions. And one thing we were very clear when those secondary conversations, we won't sell at a discount.
Sure.
Price has been set for the company. You want to pay us that? And in the Snapdeal case, we actually got a premium.
Wow.
Which actually this was in 2015.
15, yeah.
And, the deal terms were cut in August of 2015, which is when a shutter went through China. So actually our premium to, premium secondary, which got cut to a smaller premium, but it still made the right decision and got out as, because, I think we had the benefit of having invested both in the US and here. We saw kind of a bubble that was brewing. Just a lot of, irrational behavior, lots of capital being raised at insane valuations, and that's just not sustainable. Nothing ever good comes of that. And, honestly, have a little concern about that happening again.
Right. I mean, I remember you sold to the Canadian pension fund, is that right? Yeah. So around that time, it used to be, and for a bunch of companies in our portfolio, you would, January would be at 3 billion, August would be at 4, coming closer to December, they'd be raising at 4.7. It was just.
I mean, that's when you got up to that level. But, when you had companies in the 300 to 500, they'd be doubling every 6 months. They'd go 300, then they'd raise at 600, then it would be $1.5 billion. It was insane.
People would talk about selling next year at, the next round, which will be at least 2x from here, and we'll make so much money. And
Yeah. No, that's how 6 unicorns get built in 6 months or 8 months, right? I mean, that is the pace at which, searing pace at which some of these companies have grown.
Snapdeal is a great example for a case study because it's also, just as an example, it raised a bunch of capital.
Oh yeah, it did,
So,
including from you guys, right? Did you
so
not invest in Snap?
We did. So we also are one of the lucky funds which managed to exit.
Prior to.
Yeah, but we didn't necessarily time it as well as they did. Like, they clearly hit the ball out of the park on that company. And Kalari, of course.
Sure.
But, that's a company which raised so much capital that it has a huge preference tag. I think the preference tag in that company is,
$1.5 billion plus.
yeah, it's more than $1.5 billion. So if you sell at anything below that, people actually still lose money.
Correct.
Which is a great example of raising
Too much
a lot
capital.
of money
Yeah,
and then suddenly not having any of it with you, and then now even doing an M&A deal there becomes.
So now,
I
yeah,
imagine
exactly.
Well, also, I think the other thing that's maybe potentially artificially driving valuations is, some of the larger players want to deploy so much capital. The only way the math works for the other investors and the entrepreneurs by having a lofty valuation.
Sure. So I think it kind of becomes like a tiger that you can't get off, right? You get on a tiger and you just have to keep staying there because you're going to get swallowed the minute you get off.
Again, Matrimony there is a great example of an IPO. So we sold everything in the IPO. And I was looking at the share price just incidentally yesterday, and I think it's trading at 50% discount to the IPO price.
Oh my
Maybe
goodness.
not 50%, but maybe a 40% discount. It's
Sure.
trading down,
Sure.
which might also reflect recent tremors in the capital markets. But that's, we sold everything in the IPO, which in hindsight was probably a good decision.
Sure. Absolutely.
But IEX is a great public market story, though. That has been a
Which-
fantastic story. I mean,
Sure.
that honestly is, I think, a company that all of us look up to in terms of, what a great, IPO looks like. It's, got good trading volume.
You're talking about IEX?
IEX,
Sure.
yeah.
Yeah, that was a
Absolutely. So
that
I'm
would
going
have been an even
to, sorry.
better outcome had the regulatory
Not changed.
nonsense not happened in the middle.
Yeah. Well, I would argue, had the regulatory position been any better in the e-commerce market, that could have also had a few more successful companies rather than just one or two. I mean, the regulatory framework,
IEX was like unreal. They used to introduce ownership caps overnight.
right?
And it was just, I mean, like I said,
Very
that probably need another session this long, so it's not maybe appropriate to
No,
go into that.
absolutely. And you have a question, Fred?
I was just wondering about, you're talking about these massive returns, and congratulations. But whether you use hedging strategies, because it's one thing to invest, $1 million and get, when the rupee is at one exchange rate, but then you wait 10 years and your IRR is way up, but the rupee dollar exchange ratio is eating up all those profits. So I just wonder whether you guys have any sort of hedging strategy. And then that ties into the IPO. I was amazed to hear about a one-year lockup, which is a long. Any puts or other sort of straddles or any sort of option strategies to try to lock in your gain?
Sure. So is this question specifically for anybody, Fred, or it's for the panel?
One of the three of you.
One of the three of you. So I'm going to take a shot at this because it's a very legal question there, and Karan can as well, I guess. See, the way I look at it from point of view of an advisor to venture capital funds and PE funds, that's a very tough one to put any sort of a put option or any sort of a clawback or an earn-out kind of a structure that is going to work after a company's IPO. Most of these protections are built into shareholders' agreements at the pre-IPO stage, and usually all these agreements go away when the company goes public for two reasons. One is the stock exchanges don't approve the articles of the company with all these special rights. They usually instruct the companies to get rid of them before the articles are filed with the articles and the prospectus are filed with it. So that's one reason. The second reason is, even if you were to get away with having those kind of rights by way of a separate agreement, it would be very difficult to enforce many of these protective rights in a post-IPO scenario, because in addition to the exchange control that would be applicable, it would also be subject to the SEBI regulations. Now, there are various SEBI regulations which would kick in. There would be the insider trading regulations which would kick in. There would be the takeover code. There would be the SEBI ICDR regulations, which deals with issues of capital by listed companies. So under these regulations, it becomes very difficult to do any sort of a valuation reset. We typically would do these resets in a couple of ways. We would either provide for a highly subsidized purchase from the founders, or we would provide for a reset of the conversion ratio. Now, the reset of the conversion ratio cannot work because, again, under our IPO regulations, before a company files its prospectus for an IPO, it cannot have any convertible securities outstanding, so they have to be converted before the IPO. So the most preferred option of resetting the conversion ratio goes out of the window, and the option of buying at a discount from the founder also doesn't work because there are a combination of exchange control and SEBI regulations which make it almost impossible to give effect to. Does that answer your question?
Thank you. In part, and that was on the going outside. On the going inside, do either of the two funds hedge the dollar against the rupee so it tries to maintain some value from the early stage to when the exit ultimately occurs?
We don't. I mean, it's extremely expensive, and honestly, if you don't know
when you
kind of
exit.
timing, you're timing them out, you're speculating.
Exactly. We looked into it when the rupee fell sharply.
All of
I
us
think,
have.
Yeah, it just didn't make sense.
It makes sense while going in. It doesn't make sense to leave it open-ended. If you're very sure that you're putting money in the next month, you could probably do that. Okay, so any other questions from anybody else? We got about 5 minutes in this session, so I won't ask any more questions if anybody else wants to ask questions. Anybody?
Bureaucracy, but just the normal market structures, impediments. Does that necessitate, in your mind, just a higher IRR hurdle that you're demanding, or your investors are demanding, than, let's say, a more normal market? And I say normal because I live there. Restrictions and impediments. So is your hurdle maybe 30% as opposed to maybe now in the U.S. we're down to 20, 25%?
I think when you participate at the early stage, you're looking, for those outsized returns. I mean, it's not necessarily like a growth or PE where, you have a little more certainty on performance and so on. I mean, a lot of these companies either make it or they don't. So I wouldn't go so far as they're binary, but the ones that do make it, will substantially outstrip whatever your target IRR is, and those have to make up for the ones that, oftentimes many that don't come even close.
Okay, any other questions? Yes, Chris. That's a great question.
Comparing my U.S. experience with Indian investing, the ones that completely go to zero are certainly lower here. Usually you find a way to get something out, and the entrepreneurs here are very scrappy, and will find a way. It may not be, maybe 10 cents or 15 or 20 or 25 cents, but it's not zero. So I would say, you still have to have those, significant, kind of jumbo wins to make the math of the fund work for the investors. But I think you'll have more that fall in the middle and less that are kind of the washouts.
I think the answer also changes depending on what stage the fund invests at. So funds which come in at Series A tend to have, huge successes with a number of misses. And if you have funds coming in more at Series C, Series D, the number of washouts tends to, when you come in a company at that
later
stage,
stage,
it's unlikely it's going to go completely bust. But I agree with the sentiment that, it's eventually a minority of your portfolio which drives most of the return. That's just...
That's venture capital globally.
Absolutely.
That is the business.
Okay. Are there any more questions, or can we wrap up the session? Okay, wonderful. So in that case, I'm going to thank Suresh and Karan for making it here and giving us a very, very interesting discussion. I think we touched upon some very interesting issues, and we all loved hearing your viewpoints. India has not been known as a very easy place to do business, but I think progressively it is becoming a country which is getting figured out. The code is getting cracked by more and more foreign VCs. And like I said, the foreign VCs profile too has changed, so it's very interesting to look to the future with these comments. Thank you very much for being here with us and taking time to come here and speak to us. And for everyone here, thanks very much for staying awake in the graveyard shift. Thank you. Appreciation for taking time out for us. Thank you very much.
Maybe that we have a very short coffee